Good day, everyone. My name is John Ryan Dadang. I'm here to report Chapter 19, Accounts Receivable and Inventory Management. Accounts receivable. It consists of money owed to a firm for goods and services sold on. It could either be trade or commercial credit, or consumer or retail credit. Trade or commercial credit are credits which the firm extend to other firms. Uh, on the other hand, consumer or retail credit are credits which the firm extend to its final customers. The objectives of accounts receivable management is to ensure that the firm's investment in accounts receivable is appropriate and contributes to shareholder wealth minimization. Credit policy set of guidelines for extending credit to customers. The success or failure of a business depends primarily on the demand for its products. As an example, the higher the sales, the larger its profits, and the higher the value of its stocks. Credit policy generally covers the following variables. One is credit standards. It refers to minimum financial strength of acceptable credit customers and the amount of available to different customers. It can significantly influence sales. If credit policy is relaxed, while sales may increase, the quality of accounts receivable may suffer. This may result into longer average collection period. To measure credit quality and customers' worthiness, the following areas are generally evaluated. A. Character. It refers to the probability that the customer will pay their debts or obligations. Credit reports provide the background information on people and firms' past performances from a firm's bankers, their other suppliers, their customers, or even their competitors. B. Capacity. Judgment or customer's abilities to pay. It is determined in part by the customer's past records and business methods. C. Capital. Measured by the general financial condition of a firm as indicated by an analysis of its financial statements. D. Collateral. It is represented by assets that customers may offer as security in order to obtain credit. And E. Conditions. Refer both to general economic trends and to special developments in certain geographic regions or sector of the economy that might affect customers' abilities to their obligations. The second variable that credit policy generally cover is credit term. Involve both the strength of the credit period and the discounts given. Credit period is the length of time buyers are given to pay for their purchases. Discounts are price reductions for early payment. The third one is collection policy. It refers to the procedures the firm follows to collect past due accounts. Within a reasonable range, the proportion of bad debt losses and the shorter the average collection period of all other things remain the same. And the last one is delinquency and default. Whatever credit policies a business may adopt, there will be some customers who will delay and others who will default entirely, thereby increasing the total accounts receivable cost.
So good morning everyone. So my name is Him Villasiran, the second reporter, and my topic is cost associated in accounts receivable. And these are the four factors or major factors of cost associated in accounts receivable. So the first is credit analysis, accounting and collection cost. So the cost of hiring manager plus assistants and bookkeepers within the finance department, acquiring credit information sources, and maintaining and operating a credit and collection department. So when we say credit analysis, so these are the professional who assesses the credit worthiness of securities in individual or companies. So these professionals generally have an academic background in finance, accounting, or a related field. Credit analysis can find work in different financial institutions. So number two is capital cost. Once the firm extends credit, it must raise funds in order to finance it. The interest to be paid if the funds are borrowed of the opportunity cost equity capital will constitute the cost of funds that will be tied up in the receivables. So, if ang kumpanya na nagpadako sila sa ilang credit, so dapat sila makalikom og pondo para matustusan. And ang interest bayaran ang mga if ang pondo hinuam sa opportunity cost. So next is trade the delinquency cost. So costs that are incurred in the customer is late in paying. It also create an opportunity cost for any additional time the funds are tied up after the normal collection period. So this cost arises of the failure of the customer to meet their obligation when payment and credit come due after the expiry of the credit period. Such as costs are called delinquency. So next is default cost incurred when the customer fails to pay their outstanding balance. At this point, the firm loses the cost of goods sold not paid for. It has to write off the entire sales once it decides the delinquent account has defaulted and is no longer collectible. So this cost is collecting the receivables from the customers to who credit sales have been made. This is the cost on the use to additional capital to support credit sales, which is alternative could have been employed elsewhere. So next is now this is the summary of trade in credit and collection. So this is the benefits and costs. So 1. Relaxation on credit standard. It increase in sales and total contribution margin. And the cost it increase in credit and processing cost, collection cost, the default cost, or bad debts and capital cost, the opportunity cost. Second is lengthening of the credit period. So it increases in sales and total contribution margin. So the cost is increase the capital or or, or opportunity cost or higher investment in receivable. The third is granting cash discount, increases in sale and total contribution margin, and the cost is decreased profit or net income. And fourth is intensified collection reports, so it decreases default cost, opportunity cost, capital cost. And the cost is increases higher collection expenses. Next is marginal or incremental analysis of credit policies. So marginal analysis is performed in terms of a systematic comparison of the incremental returns and the incremental cost resulting for a change in firm credit policy. So this marginal analysis is comparing the incremental return to change the firm credit policy. So A, incremental profit contribution, incremental um, incremental profit contribution, incremental cost, accept the change credit policy. So incremental cost help to determine the profit maximization point for a company when margin cost equal marginal revenue. Now, if a business is earning more incremental revenue or marginal revenue per product than incremental cost of manufacture or buying the product, the business earned a profit. So next is incremental profit. Is incremental cost. Reject the change in credit policy. Incremental profit and contribution is equal to incremental cost, so indifferent to change in credit policy. So next is the inventory management. Inventories are essential part of virtually all business operation and must be acquired ahead of sales. The main classification of inventory. So inventories, we all know these already. So the classification of inventory are the manufacturing, raw materials, goods in process, finished goods, factory supplies. So in trading, and B is the merchandise. Objective of inventory management to maintain a sufficient amount of inventory to ensure the smooth operation of the firm production and marketing function. Same time tying up funds and excessive and slow moving inventory. So this inventory management, no, it enables a company to provide better service to its customer. It keeps a smooth flow raw materials and aids in continuing production operation. It checks and maintaining the right stock and produces the risk of loss.
Good morning, everyone. Here's my topic all about. Number one, credit analysis, accounting, and collection cost. The cost of hiring manager plus assistants and bookkeepers within the finance department, acquiring credit information sources, and maintaining and operating a credit and collection department. So, it is a review by an outside party in a business or individual to judge the subject's ability to repay debt, involving a review of credit score, cash flow, income, and the presence of sufficient collateral to pay back debt. Evaluates a borrower's loan application to determine the financial health to an entity and its ability to generate sufficient cash flows to service debt. So, in simple terms, a lender conducts credit analysis on potential borrowers to determine their credit worthiness and the level of credit risk. So, number two, capital cost. Once the firm extends credit, it must raise funds in order to finance it. The interest to be paid in the funds are borrowed or the opportunity cost of equity capital will constitute the cost of funds that will be tied up in the receivables. So one-time expenses incurred on the purchase of land, buildings, constructions, and equipment and the productions of goods are in the rendering of services. So in other words, it is the total cost needed to bring a project to a commercially operable status. Particular costs is capital are not dependent on many factors such as accounting, tax laws, and materiality. So number three, delinquency costs. Costs that are incurred when the customer is late in paying. It also creates an opportunity cost for any additional time the funds are tied up after the normal collection period. So the cost arises of the failure of the customer to meet their obligations when payment on credit comes due after the expiry of the credit period. So example, if there are 1,000 loans in a bank's bond portfolio and 100 of loans have delinquent payments of 60 days or more, then delinquency rate would be 10%. So number 4, default cost incurred when the customer fails to pay their outstanding balance. At this point, the firm loses the cost of goods sold not paid for. It has to write off the entire sales once it decides the delinquent account has defaulted and is no longer collectible. So it is a placeholder value for an item's wholesale cost that is used by retail at certain times when an average cost is not available. It is what you would pay the vendor to purchase the item at wholesale. So the next topic will be inventory management. So inventories are essential part of virtually all business operations and must be acquired ahead of sales. So it is refers to all items, goods, merchandise, and materials held by a business for selling in the market to earn a profit. So letter B, organizational or decoupling inventories. Inventories that are maintained to provide each in the production to distribution chain a certain degree of independence from the others. This will also take care of random fluctuations in the demand or supply. So it is when product manufacturers set aside extra raw materials, work in a progress items for all or some stages in production line, so that a low stock situation or breakdown at one stage doesn't slow or stop to operating. Letter C, seasonal or anticipation stock. Built up in anticipation of heavy selling season or in anticipation of price increase or as part of promotional sales campaign. So, it is a stock of components, materials, or goods kept at hand by a company or business to meet demand or to meet the shortfall caused by erratic production. Letter D, batch or lot size inventories. Inventories that are maintained whenever the user makes or buys material in larger lots that are needed for his immediate purposes. So it is refers to the quantity of an item ordered for delivery on a specific date or manufactured in a single production run. In other words, it basically refers to the total quantity of a product ordered for manufacturing. So letter E, safety or buffer stock. Inventories that are maintained to protect the company from uncertainties such as unexpected customer demand, delays in delivery of goods ordered. So, it is the amount required to hedge against customer induced variations or spikes in demand. So, the next topic, cost associated with inventories. So, number one, carrying cost. Cost of capital tied in inventory, storage and handling costs, insurance, property taxes, depreciation, and obsolescence administrative. So it is the various costs a business pays for holding inventory stock. So example, carrying inventory stock includes warehouse, storage, tax, insurance, and opportunity cost. Letter B, ordering, shipping, and receiving cost. Cost of placing orders, including production and setup cost, shipping, and handling cost. So it is expenses incurred to create and process an order to a supplier. So example is like an online reseller. They send invoices to a buyer to meet up for their items soon. Letter C, cost of running short, loss of sales, loss of customers, goodwill, and description of production schedules. So it is the cost which has short-term implications in the production process. Next, inventory control is the regulation of inventory within predetermined limits. Effective inventory management should provide adequate stocks to meet the requirements of the business, while at the same time keeping the required investment at a minimum. So it is being process of managing a company's inventory levels, whether that be in their own warehouse or spread over other location. So number one, fixed order quantity system. System wherein each time the inventory gets down to a predetermined level known as the order point, an order for a fixed quantity is placed. It requires the perpetual inventory records of the continuous monitoring of inventory level. So it's wherein the maximum and minimum inventory level are fixed, and maximum or fixed amount of invent can be replenished at the time when the invent reaches the auto set, reorder point, or minimum stock level. So number 2, fixed reorder cycle system, also known as periodic review of replacement system, where orders are made after a review of inventory levels has been done at regular intervals. An order is placed at the time of the review the inventory level had gone down since the preceding review. So it consists of ordering at fixed regular intervals. Various combinations of the systems can be used in the construction. So for example, so it can be modified to require cycle instead of continuous review of stock. So number 3, optional replenishment system. System which represents a combination of the important control mechanisms of the other two systems described above. So it is a type of inventory control system which combines the characteristic of periodic and fixed quantity inventory system. So the last one, number 4, ABC classification system. Segregation of materials for selective control is made. Inventories are classified into A or high value items, B or medium cost items, and C or low cost items. So, it is an inventory management technique that determines the value of items based on their importance to the business. So, ABC rank items on demand, cost, and rest data, and invent managers group items into classes based on the criteria. That's all, Mom. Thank you.